No one saw this coming.
There's been a big lending rate cut by the Reserve Bank of India.
I would say I'm definitely surprised. We never had a 50 basis point rate cut.
India's Reserve Bank delivered its response today.
The reduction recommended by the MPC is for 50 basis points.
On June 6, the RBI slashed the repo rate to 5.5%, the biggest rate cut since COVID in 2020. This is actually the third rate cut this year, bringing the total reduction to a full 1%, which is huge. But why this huge rate cut now, and what does this mean for your money? Let's break it down in this episode of Cut the Noise. Let's start with the basics. What exactly is the repo rate? Actually, repo rate stands for repurchase option. Repo rate is the interest banks pay when borrowing from the RBI. Let's say banks need quick cash. They will temporarily sell securities like government bonds to the RBI with a promise to buy them back later. But since the RBI is lending them money, it charges interest for it. That interest is called the repo rate. A lower repo rate makes borrowing cheaper. But why did the RBI reduce the repo rate? Usually, when central banks cut rates, they do it in small steps, like 25 basis points, to avoid shocking the economy or market. But this year, the RBI has slashed rates by a full 1%, and that's substantial. It signals the RBI sees a serious need to boost growth or cushion against external shocks, like Trump's tariffs or a global slowdown. Now, lower repo rates make borrowing cheaper, which puts more money into circulation, encouraging people to spend, borrow, and invest. But it can also push inflation up, as more money means more demand, which leads to a price rise. So the RBI has to balance both. But why was this big cut made now? Retail inflation has fallen to a remarkable 4.6%, the lowest in nearly 6 years. Food inflation in March 2025 was just 2.69%, the lowest since November 2021. Now this gives the RBI more room to cut rates without the fear of fueling inflation. Another important factor is India's slowing growth rate, which is predicted to be around 6.5%. Very slow if you look at how India grew previously, at an average of 8%. The RBI is using repo rate cuts to push growth. The next important question is, how does this impact your money and investments? Well, the most direct effect of a repo rate cut is on loan interest rates, especially home loans. When the repo rate falls, loan interest rates drop, making it cheaper to borrow. For example, after the RBI's recent cut to 5.5%, Bank of Baroda reduced its home loan rate by 50 basis points, bringing it down to 8.35%. But there's a flip side. Lower interest rates can hurt savers, especially pensioners and senior citizens who rely on fixed deposits for regular income. When repo rates fall, banks often cut FD interest rates too. For instance, after this latest repo rate cut, ICICI Bank slashed its 1-year to 15-month FD rate from 6.5% to 6.25%. So while home loans, car loans and personal loans get cheaper, returns on savings and fixed income investments also tend to go down. The RBI's bold move will impact how we borrow, save and invest. That's how one rate cut could ripple through your wallet. That is it for today's episode of Cut the Noise. Keep following Grip Invest for more market updates.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.